Hey folks, welcome to Snowpal Podcast. Our guest today is Jeffrey Goldberger. Jeffrey is the managing partner at KCSA Strategic Communications. He advises on capital markets, IPO readiness, and transaction strategy. Jeffrey, thanks for taking the time to chat.
Krish, thanks for having me on today.
My pleasure. We have a few different topics that we're going to get to as much as we can in the next 45 minutes to an hour. But before we do that, can you give a quick introduction about yourself, Jeffrey, and what you do in your current role?
Sure. So my name is Jeffrey Goldberger. I'm one of the managing partners at KCSA Strategic Communications. We're a New York-based communications firm specializing in public relations and investor relations. One of the key roles that I play is I work very closely with our pre-IPO candidates to help them ready themselves to act and operate as public company servants, meaning that they actually work for the shareholders. So preparing them to go public, communicate effectively, and support their shareholder relations efforts.
Thank you so much. I know very little about everything that we're going to talk about today, so I'm kind of very excited for that reason as well. And this is a pretty good time to have this conversation, Jeffrey, because there's a lot of exciting companies that are kind of in that stage right now. I was just reading earlier this morning about SpaceX, Anthropic, OpenAI. There's a lot of them who are right there, right? The introduction that you just provided to us, has all of these exciting companies in the mix of things too. So thank you for the introduction. Uh, there's a lot for me to learn during the few minutes I have with you here. Let's get started with one of the four topics we have on the list here: the biggest mistakes that you see growth stage companies make before going public.
So that's a great starting point. So you talked about SpaceX, you spoke about Anthropic. These are very large companies that have a platform. They have a platform with existing investors. The world seems to know everything that they're doing. They do a lot of public relations, and so they have a platform. With the companies that we work primarily, they're lesser known. They're growth stage companies, and they don't have that natural platform. They aren't putting a lot of press releases out. They aren't interacting with the media very much. So a lot of them are starting from ground zero. And that's a real challenge for a lot of these companies. A lot of these companies, the CEO, CFO, and COO, they're first time public company stewards. So they're used to being really great operators, but they haven't worked in the capacity of having to answer to a board of directors of a publicly traded company and their shareholders. So it's really imperative that they think about this at the outset before they're even going to go public. And I think one of the biggest mistakes that a lot of companies that are going down this path is that they don't think about communications from the outset. They have a lot of stakeholders. Eventually, when they go public, they're going to have public shareholders that buy in the open market. But at the same time, they're probably going from private to public ownership. So they have vendors, they have partners, and they have the all important employees that work with them. It's really important for these companies and these management teams to take all these constituents into consideration before going public.
Oh, that's a lot. There's a lot to unpack there. There's a number of things you said there that I would like to understand little by little. The first thing you said, these are companies that are lesser known, meaning they're early, even though they are going IPO, which means they've actually met, they have proved a number of different things. There is product market fit, they have customers, they have revenue, and they've grown quite a bit. Yet they are lesser known. What does that mean? I just want to understand what it means. From the perspective of those companies, the stakeholders in within those companies, you feel like you've done that. You've sort of been there, done that, because we start small as startups. Like I run a startup myself, and we all eagerly wait for that moment where something like that were to happen. And at this point, I'm thinking, what? When we do get to that point, if and when we do get to that point, we should have known just about everything. But surely that's not true, because by virtue of living life, you know that a number of things that even I assumed I would have known before I launched Snowpal, for instance, Jeffrey, I did not know. There were things I had no idea I didn't know, and there were some things I knew I did not know. But regardless, I did know a number of things. Can you speak to us some of these examples of some of these companies, that what are some things that they are unaware of despite having sort of been there and done that?
Well, the interesting thing that you said is you don't know what you don't know. So there's an assumption that all companies that have gone public, that they know what they're doing. And the funny thing is, you talked about it. Well, some of these companies don't have a big revenue base. Some of these companies aren't terribly established. A lot of these companies are real, true growth companies. They might be in a very hot sector like crypto, although that's had its come up in recently, or emerging technologies where they're really looking to the capital markets to raise much needed capital to allow them to go public. But they haven't done all these things everyone expects them to do. They haven't put in a comms team. They haven't hired the consultants to help them with their messaging because they really haven't had that answer to that many people. Some are self-funded companies, friends and family. Some have gone through capital rounds through venture capital or private equity. So they have gone down that path of raising capital. But the idea of communicating on a quarterly basis for a lot of these companies when they report their earnings, they've never done that before. They don't know what they're going to be talking about. They don't know what metrics that they need to go out to the market to show the world what they're doing, how they're performing, and what investors should come to expect from them. So they really haven't done a lot of these things. So I always tell these companies to step back and think about how you would like to be communicated with if you were an investor in one of these companies. What are the things that you need to know? What are the assurances that you need from management so that you're comfortable to be an investor in these companies? I think one of the things that I always tell companies is you really need to communicate and get some chips on the table. And what are those chips? Well, it's consistent communication. It's thorough communication. Don't talk in jargon. Don't talk about things that the average investor won't understand, and start to deliver. Put some bogeys out there that you are going to tell the investors that you're going to hit, and hit them. Because over time, these chips are going to come into play. They're going to be the basis for a long and strong following, committed shareholders that are continuing to want you to do well. And then it's also going to go entice others to start looking at your company.
Wow. Okay, so let me give you an example of something that I think I know, and I'll ask you some questions around that. You know, one of the things we do at Snowpal, Jeffrey, is we're a product company, but one of the products we work on is we build APIs and make them available so other companies and software businesses can integrate and build their software sooner. So in that capacity, one of the next APIs we are working on is like a fintech API. So I've had some conversations with the exchanges in New York and just trying to understand some of these fintech related items. And only reason I mentioned that is because of that product that we are working on. Some of us in the company spend a fair bit of time on the stock market, right? We spend, we sometimes day trade, we do investments and whatnot. And by virtue of doing that, I've attended some of these conference calls, things that I've never done in my life before. I've been investing for a long time, but I've never attended these conference calls, at 4:30 or 5 o'clock, and never been more excited. Hopefully, I can draw a parallel between what you said there and ask a more meaningful question, but just hear me out here. When I go to these calls, you see what's happening from a securities price movement standpoint, right? Let's say Nike reported earnings yesterday. It didn't go so well. I think they dropped 14 or 15% when the market opened today. But let's say they report earnings after market closes, which is what most of these companies do. You see a lot of activity happen. For the longest of time, I thought that the activity would kick off or happen just after they reported those numbers. Not necessarily, from what I'm learning. When the conference call actually does happen, maybe it's 1 hour after at 5 p.m. Eastern time or 5:30 sometimes.
Correct.
There's a lot more that happens, and sometimes it's the CEOs, the person who's attending these conferences or presenting has so much clout that people are actually even waiting only for that. Like, let's say when Tesla is reporting earnings, I think there's a lot happens when the conference call happens. From what I've seen, than even after they've reported these numbers, because nobody seems to care what those numbers are. They only seem to care what Elon has to say. I give you this big background to saying, does that, I mean, so even for large and established companies, communications does seem to be important, right? And you mentioned that, what are you going to tell your investors? Hopefully some of that context makes some sense. And if it does, or even if it doesn't, when you speak about communications, are we talking primarily external in the context of this conversation so far, or are we talking about internal communications that these leaders would have to folks in the company, the stakeholders that are in the organization but not
Sure.
outside the organization?
So the primary reason for the conference calls is to speak to the investment community. But the world's flat, so everybody gets the same information at the same time. So as I said at the outset of our call, is there are a lot of stakeholders. So what a CEO says in their commentary, they're talking about what happened during the quarter, but they're also talking about what's going on within the marketplace. And they're talking about what the outlook looks for either the coming quarter or the remainder of the year. So you have your investors, you have your analysts that write research on the company, you have your partners, you have your employees, because you want to keep all these people excited about your business. They're all looking for different pieces of what you have to say to figure out how that affects them. Are you having supply chain issues? How's that going to affect your partners? How's that going to affect your customers? Did you just have layoffs? And so you have your employees listening to these calls to try to figure out if they're next on the block and what's going on for their business. And the interesting thing for a lot of publicly traded companies, the old saying is you buy on the rumor or buy prior to earnings and you sell on the news. So most people have already made some type of decision. When you're looking at some of these companies like Tesla or Microsoft or Apple, you really know what you're going to be doing ahead of time, and there might be some surprises. How many handsets sold within Apple? What's going on with AI investments across all these tech plays? Those are the numbers that are driving it. They can have a blowout quarter and blow away what the analysts have to say about them, but that the spending that they're going to put into AI, for example, is well beyond what they had previously communicated. And all of a sudden, you wake up the next morning, and the stock is down 6, 7, 8%.
And I know exactly what you mean. And it's funny you should mention their spend, because that's literally what's been going on, right? For whatever reason, with all of these hyperscalers, they've reported incredible numbers, but they're spending hundreds of billions of dollars, and then the market does not react so well. But the thing I do want to ask you, Jeffrey, is numbers is one thing, right? The top and bottom lines, whether they've met what their estimates, what the analyst estimates were, and then followed by top and bottom, it's the forward guidance, how they're going to perform in the next quarter, maybe the next 2 quarters, or maybe even longer if they do know. But those are quantifiable. I mean, what they've actually accomplished and achieved in terms of numbers, revenue, and earnings, they are quantifiable, quantified numbers, right? They're literally numbers, and we can all see those numbers. But communications, the way I think of it as somebody who doesn't know a whole lot about this, is a subjective component, not so much the quantitative component there. So here's what I would like to understand. Why is it that sometimes you have these incredible numbers? I mean, is it possible? Let me rephrase my question. Is it possible that you actually did very well when it comes to the actual numbers and we're talking top and bottom lines, but you said something really silly or said something poorly, that you've actually seen things go haywire, even despite the fact that they did well and the numbers, their balance sheet backs up their, what they are saying, but they end up presenting themselves or their company in either intentionally, maybe unintentionally, or however the things happen to sort of go haywire there. If you can think of some
Sure.
examples there, that'll be very helpful for me to understand.
I don't know if I have any perfect examples, but what you said is pretty spot on. You typically have two people presenting. There might be more, but the mainstays are the CEO. They kind of give a top line review, then they hand it over to the CFO, who goes over the numbers, like you said, very quantifiable results, and whether they give guidance and if they're updating it either up or down or keeping it consistent. Then the CEO comes back and he gives some conclusion remarks. There are investors, analysts, institutional investors that are literally analyzing word by word. It's almost like when you listen to the Fed. So when you listen to Jerome Powell, there are people that, in organizations, they slice and dice every single word. They look at how he presented himself. What did he feel? Did he look like he was self-assured? Did he look like he was hesitating? They're really trying to get whatever insight that they can, what they believe will either affirm their investment thesis or go south in what they think is going on. So very often, that's why these things are scripted. You spend a lot of time thinking about what are the questions that investors want to hear answers to, and what is the story that you want to get across. And companies, whether they're very small companies or very large companies, they spend weeks and weeks preparing for the formal remarks and for the Q&A because they know what they say matters. The numbers are cut and dry, but everything else is kind of on the table. And other things come into play. I mean, look what's going on in Iran and how that comes and plays into companies that you think would be unaffected by what's going on. You talk about petroleum. Petroleum is used throughout all types of manufacturing, and you don't even think about it. You think about transportation. So someone could have had a great year, but then their transportation costs have gone up dramatically. We read over the last couple of days that some of the major airlines are going to boost their ticket prices by up to 20%. They're adding another $50 for baggage to be stowed. So all these things come into play. So great quarter, but then all these outside factors are coming into play. So it may not even be what you're saying, it's what's going on outside in the world that could affect your results going forward.
You know, uh, I'm glad you said Jerome Powell, and it is after hours because every time I I'm very excited when the Fed chair actually has a conference because I always note the chart at 2 p.m. They announce the rates whatnot at two
Right.
o'clock, and at 2:30 there's this conference. And I think I've taken screenshots of how the market reacts. It's just, for someone who's got an immaculate composure. He's so calm when he speaks. Always compare his demeanor and composure to actually how the market reacts. There's a complete disconnect between how he speaks and how the market reacts. And I always found like it's kind of funny. Uh,
Well, but the other thing that's coming into play is the disdain that President Trump has for Jerome
yeah.
Powell and his policies. So he's doing his day job, but his side job is maneuvering through pressure that's being put um, on his position and the role of the Fed. And so it's a different game than it used to be because of this undue pressure or pressure
you know,
that is deserved. I can't tell you where it lies, but it's certainly an added pressure that has changed. He has become a little bit more combatant recently, um, where he is a little bit more middle of the road, and you couldn't tell, you wouldn't want to play poker with him because you'd probably lose. You wouldn't ever know if he's bluffing. But now he has added pressure of what's going on from the presidential suite.
It's funny you should mention poker. That's one of those things I do to break loose from the worries of the world. I enjoy Texas Hold'em a lot, actually. Back to what I was asking earlier, Jeffrey. There is so even as you said, the CEOs and the CFOs are going to these conference calls. I want to take some examples. These are not like this is not empirical data, but I just can think of some examples. SMCI is one of those companies, Supermicro. I think the CEO's name is Charles Lang. Hopefully I'm pronouncing his last name correctly. Uh, I, I I don't know if I could be wrong, but from my recollection, anytime I've heard him actually say something about the company or what they're doing, it's almost never seems to have worked out well for actually the price movements of that particular company. They've had a lot of issues. They had some issues recently as well. But outside of the core issues, sometimes I think communication. So, giving giving taking that as some sort of an example, good, bad, or ugly, what are some things that you think? I don't know, that they should be saying, because the idea is for them to say the truth, right? You don't want it to be that hopefully there's no deviation from the actual truth of what they're trying to do or what they are intending to do. So how do you present truth in more than one way? Truth is very quantifiable, right? I mean, there's only one way to say it. 2 plus 2 is 4. I mean, you cannot say it any other way, but that's not the case when you're doing these types of communications. I recognize that. Yet, as somebody who's a developer myself, Jeffrey, I try to quantify everything because life becomes a little bit easier when you quantify things. And so, some of us go to great extents to try and quantify things that are not quantifiable, and then you give up on things not being quantifiable, and then concede. But you try your best to doing that. So, can you think of scenarios where somebody is saying something which is remarkably silly, or silly to even like a 10-year-old, or is it only silly to people who are really smart at understanding the nuances and the differences of what is being said?
So I don't think I would look at it that way. I would look at it, what's the job of the chief executive officer, right? They run the company. They set the tone. They set direction for different initiatives. Part of the job is being a cheerleader. Nobody wants to work for a CEO that doesn't have confidence, that isn't excited about their business, that isn't excited about the industry. If you would get on a call and Tim Cook would say, you know what, I don't know. I don't think people are going to be buying iPhones at the same rate that they used to. Our app store, you know, it's not as important to our business as it used to be. And they go on, and you're like, well, I invested in the promise.
Right.
If I didn't think that there was upside potential to this company, why would I be involved? So is there a line that you have to stick closely to? Well, you always tell the truth, but you also have to go and show enthusiasm for the business. And if you're having challenges, what are you doing to remediate those issues and come out the other side a stronger company? I mean, you look at Mark Zuckerberg. They seem to be late to the AI game. And everyone was like, oh, they're in big trouble now. They're going to have to play catch up. And what did they end up doing? They ended up spending tremendously against it, and they started to catch up. So it, these are things that, like, they recognize how investors are viewing what they have to say, how their customers are viewing what they're saying. Sometimes they have to do a pivot to to please the crowd, but also put themselves in the position so that investors in particular want to remain investors and bring others into the game. So it's a balancing act, and it's certainly not easy. And I would say those companies, one, that consistently deliver, and when they don't deliver, they give very truthful responses to what happened and what they're doing to change things to make them better. Those are the companies that over time do really well. Those that come out of the gate and they miss on earnings, or they have a bad product launch and they don't communicate it very well, no one's believing them. So they haven't put any, as you said to Texas Hold'em, you want some chips on the table that you can draw from at some point, because you've always been truthful. You've always given the right answers. You've always tried to move the company in the right direction. When you stumble your toe, you take some of those chips off the table, and people will give you some time to regain your momentum, your footing.
Okay, so I presume some of the things that they have to do to appease their investors and the general public and whatnot is probably domain agnostic, I have to believe, right? And how they present, what they present, how they communicate, what they're doing, where they expect to be the next quarter, the next 6 months, a year, and so on. Are there some things that are industry specific, Jeffrey? In other words, if I'm in the semiconductor business versus the software business versus the healthcare industry versus the insurance industry, are there things that you expect for them to be doing differently by virtue of the domain that they happen to be in? If so, what are some of those things?
Listen, there are obviously nuances to different industries, but if we're just talking pure communications, I think there's a playbook that everybody has to employ, and 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 you have to stick to it. once you lose people's confidence, it's very hard to gain it back. And so I would say that successful CEOs, whether they're in tech, this guy that was in tech, he probably could have gone into healthcare, he could have gone into finance and been very successful. It's these individuals that have that ability to gather consensus, to drive results, and to communicate effectively with their different constituents. I think you could take any of these guys and put them in another industry, and they would likely be just as successful.
So you mentioned, maybe it is fairly obvious that, it's hard to build reputation. It takes several years and decades, but it's easy to ruin the reputation that you've built. As true as that is, I want to play the devil's advocate there. You have companies like Chipotle, for instance, that had a lot of these food poisoning issues. They had a particular CEO, and then they hired somebody else who now happens to, I think, be the CEO of Starbucks, if I'm not wrong.
Correct.
And then things changed dramatically, right? I don't know what they could have magically fixed in the way they served the food, but just by replacing one CEO with another, problems seem to have disappeared. So the only thing I can think of as somebody who's a long time customer of Chipotle is the fact that they started communicating differently to their customers. They may or may not have fixed, I don't know, I'm just speculating, the core issues necessarily, because it seemed too quick. And if somebody who's running it for so long couldn't fix it, I just wondered how the next person was that much better that they could fix it. Or is it because that some people have the clout, or I don't know, how they actually speak
Sure.
to the market and how they're able to get things done. So uh, that's one example. Another one I can think of is things like CrowdStrike, the security company. They've had these breaches. It was like 4 years
Sure.
ago, if I'm not wrong. The stock plunged from like $500 to like somewhere in the mid 200s, but then they came back up. I don't know where they are at, but I have to believe that they've caught up all the way through. So in other words, these are I mean, that was again a Microsoft-ish vulnerability that was exposed by CrowdStrike and whatnot. So some of these companies. So is it really true, Jeffrey, that reputation has to be guarded carefully, or is it just depends on who you are? Sometimes reputation can you can afford to not lose it, even if you do something that is ridiculous, and maybe other people may not survive those types of situations.
So I think we're talking about two issues here. The first one that I would like to address is thinking about who your current CEO is and if they move on. And if you've been very successful over a sustained period of time, the next person that comes in is going to be challenged to replicate. Two things that go against you. That CEO that was likely a founder has been there for a long time. They went through tremendous growth, and as the companies mature, you can't achieve the growth levels that you had historically done. But think about the new CEO of Berkshire is always going to be compared to the Oracle of Omaha.
Right.
Howard Schultz from Starbucks, they went through several CEOs, and he had come back, I believe, twice. You talked about the CEO of Chipotle that left. Um, you can go back in time. You look at Disney when Michael Eisner was there, and he stepped down. Mike Ovitz came in, and he didn't do very well. So you have seen this over time where it's there is an aura that former CEO had that Midas touch, uh, whether it was their own doing or they just built a great team around them. It's theirs to own, and those that come in after them are challenged to replicate or find their own footing. I think the most recent really strong example is Tim Cook. I think the company Apple has done better under him than ever did under Steve Jobs. And I think if you go back and look over time, it's performed extremely well. So that's one issue. And then when you have um, big issues, whether it's you know food poisoning issues for these multinational companies, whether it's a McDonald's or a Chipotle or any of the others, um, those are moments, or security breaches. Those are moments in time, and all these companies prepare for these types of events. And I think it's those that get on top of it very quickly. They recognize that there was an issue. They put into place measures to stop or slow down whatever issues, to isolate those issues, and then what they do in terms of a plan to execute against that. Um, the issues years ago with Chipotle, with their food contamination issues. Um, it took them weeks to overcome that. Then you had the more recent one with McDonald's, and they turned it around very quickly. So, I think those are two different issues that we're talking about. It's succession, and what do you do when there's an issue?
So you said a couple of things there. I want to go back to Apple. I'm going to slightly have a different view from what you shared there, but I have a
I saw
question
you
related to that.
smiling.
Sorry?
I
You
saw you
said,
smiling.
yeah, because you said, the company's done remarkably well. Well, they have done well. There's no denying that. But here's what I want to say and ask a follow-up question. But let me say what I'm thinking here. Taking a company from $0 to $1 is excruciatingly painful. I mean, a lot of us are living through that as folks who are running startups. So taking something from $0 to $300 billion, which is kind of where I think it was at when before we all lost Steve Jobs, was monumental, right? I mean, it's no other way to say it. Zero to $300 billion. And now, sure, Tim Cook has taken it from $300 billion to almost $4 trillion. I think they're down now, probably 3.5 trillion. That's 10 times. So there's two ways to look at that. And I've had this conversation with somebody else in the past, which is kind of why I had that smile, which is, from a dollar standpoint, sure, 2.7, $3.2 trillion is what Tim Cook's been able to add to the market cap of Apple. So if you looked at that, you'd be like, yep, no, Steve Jobs didn't get it to 3 trillion. But we all also recognize how difficult it is to go from a nobody to a company that the world recognizes, and then you give that to someone else who's able to take that, and the market dynamics change, the value of money, currency changes, and things changed a bit there as well. But the reason I mention that, Jeffrey, is I want to ask a question there. As the founding CEO of Apple, Jobs was known for his products, right? The product lines that Apple actually had. I love Apple. Everything I do uses Apple, but I'm still waiting for this next new product since iPhone, and a lot of us are eagerly waiting for that. On top of just adding a few bells and whistles to every machine or every phone, which means Tim Cook's specialty seems to be in services, right? Apple Music and Apple News and all of the revenue that comes from services and not from products. So I think it's a great example that you took there, because it's the same company, the same incredible company, run by two people, but with a completely different foundational value or approach or mindset or whatnot. I mean, a lot of us who thought of Apple as a product company, I mean, like it or not, a lot of us are beginning to look at them as a services company, surely they do have products, but the services revenue is where they've been making all of the difference. The question I have as a follow-up to this summary, to some extent, Jeffrey, is which means you could take the same incredible large company, a hyperscaler, and have the world look at it slightly differently. Does that mean as the leader who's running these companies, where do you want to be? In other words, do you want to stick to the core paradigms of the organization, or do you go with what your strengths are, as some might even say Tim Cook has done here, and then take what you have and take it forward using your ideologies and strengths and weaknesses, as opposed to stick to what the company gave you to begin with?
So let's stick with Apple. Um, Steve Jobs was a visionary. He was the designer. He certainly launched revolutionary products. He worked very closely with Johnny Ives from a design perspective. And I would say, since he hasn't been running the company, since he passed, I would say that innovation has taken a back seat a little bit. I don't get excited about the next iPhone. You're right. The changes that they make are de minimis compared to when everybody first stood in line for their iPod Mini outside the Apple stores. I just think it's part of a maturation process that all companies go through. Um, yes, these companies still try to innovate, but at the end of the day, they have such a huge install base. They have such a huge base of people that are loyal to their products and their services. So I think whether Steve Jobs was still with us and he was still running the company, I still think that he would have had to bring in someone like Tim Cook to take it to the next level. He could have taken a different role. I mean, look what Bill Gates did. Steve Ballmer. I mean, he was an operator. He's
Right.
not the brains behind everything that's happened and the beginning of what happened at Microsoft. But he came at the time where you allow Bill Gates to do what he does well, and he wanted to concentrate on other things that interested him, and you needed someone that could go in and really run this company, and they had tremendous growth under both of them. Just different type of growth if you think about it that way.
Interesting, right? Yep, that makes sense. Um, okay, so let's go to a couple of other things that I would like to talk about here. Um, One of the things is we have in the list here is how poor stakeholder communication destroys value. Uh, we've talked about good and bad communication. I mean, it's again, these are early growth companies. They've not done this before, so they're bound to make certain mistakes, but they work with folks and organizations such as yourself to help them present the best versions of themselves. But even after all the planning, even after all the desires and the good intent, you know, things sometimes don't happen as you expect. What are some of what would you attribute that to be? Are there generally things outside the control of the organization, maybe the micro and the macro conditions? We talked a little bit about that, maybe the geopolitics. Are those generally the types of things that happen to shake the plan? Or do you think even outside of nothing else happening in the world, which is a strange thing to say because it's something happening all the time, but even assuming ceteris paribus conditions where things are not changing dramatically, have you seen companies make the same mistakes that other companies have made in the past and just not fixed what they have done for whatever reason?
So when I think about this, listen, there's always going to be market constraints and market challenges. There's going to be macroeconomic conditions that are going on, industry specific challenges. I think it more so comes back to, are you willing to be and are you committed to being a good communicator? I've worked with many a CEO who, at the end of the day, really didn't care. And you could tell by the way they communicated. They had a set script when they did earnings calls, never deviated from it, um, didn't answer questions thoroughly during the Q&A session. Um, they wouldn't go out and market themselves, meaning go out and meet with institutional investors throughout the quarter. They didn't want to attend conferences, and they always felt, well, if I perform as a company, everything's going to be fine. And the truth of the matter is, it doesn't work out that way because people are buying, they're betting on the horse as much as they are on the carriage, and the carriage being the company. They're betting on that CEO. They want to believe what he has to say. And if he doesn't give a damn or doesn't appear to give a damn what they think and isn't going to communicate in a way that's satisfactory to these individuals or these institutions, people are going to vote with their feet. And I would say an interesting thing that's gone on over the last 10 years. I've been doing investor relations for 30 years. And for most of my career, we concentrated on that institutional investor. And we ignored the retail investor. And what we have learned, and it's not just about meme stocks, but there are trillions of dollars in the marketplace of self-directed individual investors that are making their, at least for a certain portion of their portfolio, their own decisions. And they're treating these companies just like an institutional investor or a sell side analyst. They're doing their research. They're coming together in groups. They have chat rooms. So one of the things that's really important with these individual investors is that they want to feel something from that management team. They want to feel part of it. And if they feel like management has done them wrong, they're going to be the first person to get on that chat board. And then it's going to get bigger and bigger, and it's going to become a self-fulfilling prophecy. So it's not just about appeasing the big institutions, it's making sure that you're communicating with this large aggregate of individual investors that really play a tremendous role in the liquidity of publicly traded companies.
Wow, that's amazing. Thanks for sharing that, Jeffrey, because I had absolutely no idea. Because, when I go to buy or invest in a security, I do look at the ownership because, I can think of Datadog, for instance. I could be wrong here. One of my favorite companies,
Sure.
probably headquartered not too far from where you are, actually in New York. If I'm not wrong, I think it's one of those companies where it's mostly institution owned. And there are other companies that are not so much, right? Like if you take Meta, for instance, I think it's still like 40% is owned by retail investors. Like,
Yeah.
there's Apple could be 50%. And sometimes, when I make a pick of where to put the money, I actually sometimes lean, on the side for whatever reason where there's more retail investors. I feel like hundreds of thousands of millions of people that have nothing to do with each other and have no way to talk to each other can collectively make better decisions, whatever better means, than some other company that's primarily owned by mutual funds or institutional investors, because they can move the needle all ever so suddenly, right? Just from what I've seen. But I want to ask you, based on the interesting that you mentioned there, Jeffrey, is you said that things are different. If I'm not wrong, paraphrasing what you said, what if that is in fact true? What do you attribute that to? I mean, why was the onus not so much on retail investors, at least to the extent that it is today, 20 years ago compared to today?
So a lot of different reasons, but I think a lot of it has to do with the flow of information today. Years ago, the best information always got to the institutional investors first. There was a little wink and a nod and whispering that would go on between management teams and institutional investors because they wanted to court these institutions. And they were getting information, better information, and very often ahead of where the masses got it. So they had a tremendous decided advantage over the retail investor. Well, the SEC's gone out of their way to make sure that the playing field is level. It's called fair disclosure, meaning that when you put out material information, it has to go out in a way that everybody gets that information at the same time. So no one has a trading advantage and can get it in or out of a stock more quickly than somebody else. So that's leveled the playing field. But all the information that individuals have access to, again, they get SEC filings, they can get access to the research reports, they can go and read information about stories that are being written about the companies. They can go on these big chat board communities and share information. So there's so much more information that's at the fingertips of these individual investors. So you are seeing a lot of these larger companies understand that this is the lifeblood of their company as much as the institutions. So they're communicating to make sure these people understand the business very well, and they're understanding that some of their success and some of their failure is going to, excuse me, Alexa, stop. Their fortunes rise and fall with the retail investor. So we are seeing a lot of companies put programs together that are specifically directed towards retail investors.
Wow. You know, I feel like we're living in two different worlds, my friend Jeffrey, even though we are geographically 5 hours apart, I think driving distance. And here is why I tell you that, and I want to get your thoughts on it. Something that you said there is very, very interesting. Everything that you said about how things were from a retail investor standpoint in the past, uh, I'll tell you that as a retail investor, Jeffrey, I feel exactly like I'm in that state right now. So I shudder to think how it was like 3 decades ago. Because a lot of times I feel like I keep complaining to my wife, after these earnings reports come out. I'm like, why? I'm pretty sure these institutional investors get this information sooner because when at 4 o'clock, the earnings numbers are supposed to come out. I've literally timed this a lot of times. Like it'll turn 4 o'clock. By the time it is 4:00 and 10 seconds, you would see a lot of activity, like millions of shares traded with like a 12% fluctuation on either side, as an example, right? Just a random example. And I always told my wife, I was like, you know what? There is no way this is like new information or it's coming out at the same time. But it could be, I'm guessing, I'm pretty sure things have improved, like you mentioned there, right? But probably there's still, is it possible that there is still a gap? In other words, or is it because of systems being different? Like I know the Bloomberg terminal, it's like what, $30,000 a year or some really expensive
Correct.
subscription. A lot of us retail investors don't have access to those things. And the tools that we're using also, Jeffrey, like I use Fidelity and E-Trade. And one of the reasons we are building this fintech API, to be honest with you, is because of all the gaps I've identified in using these platforms as a retail investor. I feel like these systems have continued to remain dated, where they don't let me do things the way I would rather do. And I'm not talking about even complex activities, right? I'll give you a very simple example. Let's say I'm, entered into a position. I don't know. Uh, let's say I bought Apple this morning, right, at $251 or something like that. And then I have a stop loss on it, maybe a trailing stop, which is 1% for ease of conversation. And maybe it actually did go up in value. So I decided to close my position. But, timing matters. And as a retail investor, we're not dealing in milliseconds and microseconds, right? We're dealing in seconds, literally, which by virtue of that, you're only losing out to these large institutional investors. But outside of that, if I want to go and close this position, Jeffrey, on Fidelity or E-Trade or all of the platforms that I've actually tried out on, I
You're
have to
one
go to
step. You're one step too late
because
to
I
get
have to
out.
go to a different page to cancel the stop loss. It takes 2 seconds. I have to come back here. So as quickly as we try to do it, it takes a good 6 seconds for it to happen. And you're like, oh my God, things could have moved faster. The reason I give this long-winded example is there still a gap, or you think things have gotten more even in the recent past?
I think it has gotten better. I still believe to some extent the institutions have better access and better information coming their way. But what we haven't brought into play into the discussion is the fact that computers are trading and they don't care what the business is. They are built on algorithmic trading, and the machine's making the decision, and it can make us, less than a split second decision and get execution done. And so you're fighting an uphill battle. And that's why when I think about it, retail investors, you have to take a long term view towards things. The day traders, it's almost like playing in Vegas. You don't always win. The house usually wins, and you're at a disadvantage. So I always talk to these retail shareholders. You can't think about it as the trade. You have to think about it. Do you really like the company? Are you going to take this position? Are you going to hold this position? Because you know you're fighting the institutional world. You're fighting the computer algorithmic trading world, and you can't win that fight because these companies have put billions and billions of dollars against technology and research, and you just can't keep pace with it.
Very well said, right? You mentioned we got about under 10 minutes to go. So let me ask you a couple of quick things and I'll give you an opportunity to ask me anything if you want to ask me. We talked about you mentioned algorithmic trading. We talked plenty about communications, the rights and the wrongs. I want to see if, not intentionally so, but I think there is a relationship between the two, and tell me if this makes sense. Now, when we're talking about computers making decisions about trades, entering a trade or exiting a trade, and the pace at which they happen to do it, and you take communications as well, right? So let's say in the conference calls, or even before the conference calls, maybe in the report that they release, essentially the earnings reports, is there language that happens to that should or shouldn't be in there, Jeffrey, as we enter the world of LLMs and algorithmic trading? Is it possible that say for the same numbers that the company is reporting, maybe there's some justification to these numbers and whatnot that might go into some of these reports that are sent out? that if they said the same thing but slightly differently, and the LLMs that react to it, and therefore the tools that react to that analysis might end up making maybe the decisions differently. So does it mean if some of this hypothesis is in fact true, maybe it isn't. If it is, does it become even more important as to what the language, even the written language, should be so the trades are happening correctly when these computers make those decisions?
That's a question I'm not sure I can answer. I would say that companies still need to communicate with people that are making active investment decisions, that are individuals and institutions run by individuals that make decisions based on their research, based on reading press releases and earnings transcripts and so on. I think the LLMs are going to have their play. They're probably going to make it even more lopsided towards that computerized trading platform. But I but I but I don't believe that today that algorithm trading is pulling in that information. I assume it's on the cusp already in there, but I think it's very hard for someone to try to communicate with somebody you can't directly communicate with.
Correct. Which means, as we look into a future that's hopefully humans are part of that future. We all believe that hopefully is the case, but there are more machines that come into play. You're talking AI agents, you're talking agentic AI, you're talking a number of different things that were never there in the past. So should the fundamentals here change in some form, way, or shape? Because perhaps your audience is not just Homo sapiens in the near future, but it's a combination of machines and humans who are the recipients of whatever it is that you're communicating to.
I I think that question's above my pay grade. You know, we have made tremendous strides in broadening the communications programs for our clients to reach, again, those active investor audiences, whether they're institutions or individuals. What's next? I couldn't tell you. I mean, I read this morning in the journal that a group is developing an AI trading platform that you put in your criteria for how you want to build your portfolio, and it will build your trading program for you. I mean, is it all going that direction? It might be, but the fact that you can go and put prompts together, just like people are building their own agents, with no coding background, that these companies are building platforms that you can prompt and then and take your entire portfolio and give it prompts to help build what your portfolio looks like and what the trading's going to look like. I mean, boy, I mean, the
You,
next 10 years, next 5 years are going to be incredibly interesting and challenging.
I could speak for 1 whole hour about the last thing that you mentioned there, which is very exciting in terms of machines and trading. So if you ever want to come back on the podcast, Jeffrey, I would love to talk a lot more about the very last thing that you said there. But before we have what 7 minutes to go. The last thing I want to ask you is, one of the things I have listed here is why communications plans should be built 6 to 12 months in advance. The quick question I have there is, I would have thought that that would have been the case, but the fact that there is that we want to have a conversation about it tells me that that probably is not the case. So does it actually mean there are companies that are going public, because that's a long time in the coming? Are they actually unprepared, meaning they don't engage with firms, the communications organizations, up until the last minute or the 11th hour?
I hate to admit it, but sometimes we are the last call. We are the afterthought when we should have that seat at the table. Communication should be at the forefront. We work with a lot of companies, call it 6 to 12 months ahead of an IPO, not only to help them put the infrastructure in place, but start to build a profile for themselves, have them start doing public relations so they're part of the right discussions. So they are setting themselves apart in the marketplace so that when they do file and then they do go public, people are aware of who they are and they have a natural point of entry to be part of broader discussions. The other thing about building some of these relationships with the media is the media can be used when you need them. If you need to go, if you have big news and you want to go and get it into the marketplace, you can go directly to specific reporters that you know have a big following and will write something that goes beyond that press release to give you more more opportunity to tell a deeper, broader story of why this news is important to the company, its customers, and its shareholders. So putting these things in place and making them part of your normal course of business activity before you file to go public is really important. And then continuing to do that through your life as a public company.
Last two questions for you. One is about food that I'll come back to after you ask me anything you want to ask me. But the very last one before that is the question that, is has to be almost asked of anybody these days. I get asked all the time as well as somebody who's running a software company. Machines are getting better and better. Claude's releasing models almost every other day. Well, they released their source code, I think, yesterday, but that's not a good thing. But otherwise, generally, they release models that's benefiting everybody. Uh, the question, Jeffrey, is do we, in whatever, in the space of what you're doing and what you've been doing all these years, do you see a moment of reckoning where you're like, you know what? I don't need to do this. The tool can do it. My team doesn't need to do this. The tool can do it.
Yeah.
Or do you feel like you're able to scale more, work with more companies because of those tools? Or what are some of the adjustments that you see you
Sure.
might or you're making because of what's happening in the market?
No, this is an ongoing discussion. When we first started using AI tools, we had long discussions of whether or not we needed to disclose this to a client. How dare we pay these people to do our communications and they're using tools that we could use ourselves. And so we had lots of discussions of how we are going to utilize them. And the fact of the matter is now everybody is expected to use these tools within our organizations. Our clients know that. I will use a phrase that's probably not a little bit off color, but it's shit in, shit out. So you still need people that can think. You still need people that can put together original thoughts and can put the right inputs into one of these systems to get the output that you want. If you can't put that together, how do you expect to have good outputs? And so we think that what we do for a living remains integral to what these companies are doing, but we want to use the tools available to us to make us more efficient and work better. The other thing is we are building our own proprietary tools. We're building agents for our clients. So think about putting all the SEC filings together, presentations, um, conference call scripts, press releases, and then prompting the system to build a press release based on the tone and previous news and to get your first cut from that. Maybe it gets you 70% there, maybe 80% there, but you become more efficient and you take advantage of that knowledge base that you built for each of these companies. So we're building agents for each of our clients and we're utilizing that to help us to be more effective communicators for our clients.
Very well said there, right? I'd probably add one more thing if it adds any value there, which is, I know we had I really enjoyed this conversation, Jeffrey. Thank you so much. Uh, Plenty of learning from a communication standpoint, going public, what it means. We talked about investments, things of that nature. I had a conversation with somebody in Houston about oil and gas, right? He's works for a company, he runs, does consulting in the space of oil and gas. I went to school in Houston, but I know nothing about oil and gas. I had a conversation with somebody not too long ago about energy. He actually helps companies that are, building renewable energy and whatnot, investing those developers and trying to get them in talks with investors who are spending money investing in that space. Now, I take these three examples because they're very distinct from each other. I don't really know anything about any of these areas necessarily. And one could argue that I could go use Claude or ChatGPT and find out a lot of information about this and pretend to know things, right? Um, but that's not going to be good enough because people who've done this for a long time and have the richness of the experience know how to use these tools better. So they are already at a better starting point, way ahead of somebody who does not know anything about this. And I say this because it's easy for me to understand and appreciate and explain this better from a non software engineering standpoint. Because when I talk software development, you have your biases that go with it. And I keep thinking, sure, Lovable should do it or something else, or low code, no code, and code generation, which is all great. We use that ourselves. But it's undeniable that you need somebody who's done this for some periods of time, hopefully done it well enough, so you know what works, what does not work, and how you can find a tool that's better than the other. And you know where the tool has a role to play and where the human mind and the intellect has, and your agencies have a role to play. And I think I'm trying to assert that in a lot of these conversations that I'm having, because I've been able to digest that myself by having conversations with people who know a lot more about certain areas than I actually do. And I can appreciate what they would bring to the table, because you gave the same tools to Jeffrey and to Krish. Clearly, they're not going to be using it the same way, because Krish has no idea what to do to take a company public, right? It's just not the case.
Right.
So I just want to call out for the fact that while there is that anxiety, I think we've got to find a way to make ourselves more productive, which I think we're living in a wonderful time and age where that is actually possible. You can build stuff without the skill. You can build stuff without having the money or the backing or the funding to build it. So I think these are interesting times. I just want to add to that. I have a food related question for you, which is non technical, by the way. But before that, do you have anything you might want to ask me, Jeff?
So you're an entrepreneur. You've built a very good company, and seems like you have lots of aspirations to continue to grow it. Have I scared you from going public?
It's a good problem to have. It's a good problem to have. I will tell you. Um, I've worked for a lot of startups over the years. I used to work for Oracle in one of my first jobs. I enjoyed it a little too much at the time, and I was worried that I was getting too comfortable working there, working with those brilliant people that would end up retiring in a company like Oracle. Maybe not, because they've been letting go of people, tens of thousands of people. But you know what? But the point I'm trying to make there is, I made a conscious choice to work for smaller, more chaotic organizations with little money before I founded my own many years ago. And I think the thrill, and it's not easy. Nothing is easy in life. This is certainly not easy. There's other easier ways to make money. But you mentioned commitment, right? When you mentioned that, you talk, the passion and the commitment, and the need and the urge to do something is probably what keeps a lot of us going, right? It certainly cannot be the ease of being able to do it, because I always wish every morning I wake up, one part of me is like, Krish, can I just pick up like a W-2 job where you just get paid on the 15th and the 30th, and you have like one boss to report to? When you run a company, you recognize that you're never your own boss, and you have 100 of them. You listen to your clients, you listen to your prospects, you listen to whatever other people. And as you get closer to that point you're talking about, Jeffrey, is, I'm guessing, people then start to learn about everything else that they had no idea about too. Talking to you made me understand that and appreciate it, because I kind of thought that, okay, I worked for companies that have gone public, smaller companies. I always thought that, okay, given that they've taken it that far, they should exactly know what's going on. But what you've clarified tells me that just as much as I've been making mistakes along the way here, we are all going to continue to make those mistakes even when it comes to that point. So we need experts such as yourself, to guide us, tell us what's right, what's wrong, how has it happened in the past, and or how it should happen in the future, right? So I think it's always important to engage with people who are better than you, so you at least do those things correctly.
And it's not always better. It's different perspective, different experiences, and I think we learn from each other. If
I'm
everybody had all the answers, none of us would have work to do.
absolutely right. Perfect. Couldn't agree more. Anything else you want to ask me, Jeffrey?
No, I want to express my appreciation. I think this was a great use of my time. I hope that you gained something from this. I certainly did through the discussion, and I hope that your followers will enjoy this as well.
Oh, I have no doubts. I'm going to let you have the closing comment in a second. But my last question to you, probably the hardest one that I've asked you, or maybe not, is, say you're going out for dinner. Um, you could pick where you're going, right? I mean, whatever cuisine. Can you give us what your order might look like for an appetizer, entree, and dessert. And it can be from three different cuisines. It does not have to be from the same cuisine.
I have this discussion with my eldest daughter all the time. So we would start off with a shrimp cocktail, jumbo shrimp cocktail. We would follow that with a big New York strip, a 3 pound lobster, and lava cake.
So I
And
guess
then,
the appetizer and the entree is both seafood, correct?
like the protein, you got to keep the protein going. Yes.
Right. And then the cake is the perfect, right? This is great. And, uh, you don't live too far from New York City, I reckon. I mean, how far
I
are
do
you
not.
from? Yeah. So I know we live about 4 hours away, and every chance we get, we go there. We love New York. I'm vegetarian. Uh, well, we love Chinese food, and there is some incredible vegetarian dim sum places in like New York. Unfortunately, DC does not have any that I can think of. Like not one. I'm not saying like 10. There is not a single vegetarian dim sum place in the metro that I know of. I've lived here like all my life, but I just don't know if they're even here. Um, but good to know your order. Sounds pretty nice there. Just by way of introducing Jeffrey one more time. Again, appreciate you taking the time, Jeffrey. I really enjoyed the conversation. Jeffrey Goldberger is the managing partner at KCSA Strategic Communications. We'll include the link to kcsa.com and to Jeffrey's LinkedIn profile. So definitely do reach out when you have the need. Um, that being said, Jeffrey, I'm going to let you have the closing comment and then we'll call it wraps.
No, listen, I've had a long career doing what I do. I like working with people. We like helping people. And, good communications is not just about work, it goes throughout life. And good communicators tend to be successful at all facets of their life. So I'm proud to be part of this industry. And I really appreciate the time with you, Krish. It was nice to spend time with you.
My pleasure. Again, folks, thanks to Jeffrey, and until next time, bye bye.